Good evening. Good evening, everyone. My name is Adam, and I will be your speaker. I am a chief market analyst, and I will be your speaker / presenter for this evening. And first thing I want to do before we continue is to, first of all, obviously welcome you. Thanks for joining me. This is a live webinar. It is now Thursday night. It's a Wednesday night. Sorry, is it? No, it's Thursday already. And I know that even in the next couple of hours, we've got earnings coming out from Apple, Meta, Amazon. We're going to have to see how that goes. First thing I want to do is make sure that you can hear me. I've got green lights across the board. Microphone should be good. Battery's a bit low, so if sound goes, I will just swap it out to the backup. I've got lots of other options here. You should be able to hear me. You should be able to see me, and ideally see the slide deck, the blue background, white text. And the title of today's webinar is, will the S&P earn a new February high? Spoiler alert, yes. Okay, but let's go down and have a look. February is not always a great great month. Year-wise, September and February tend to be the weakest ones. So we'll see actually how that goes. Let's just continue on here. So we've got a risk disclaimer. I need to give you a moment to digest. And while we are doing that, I'll give you some background behind myself. So as I said, I'm based outside of London. I live in Herne Bay on the coast, very close to the cliffs of Dover, so just across the way is France. I'm about an hour and a bit out of London by train. I earn my income through trading, so I'm both a day trader and a swing trader, and I also manage my own stock portfolio. I actually manage some friends and family money as well, and that's pretty much my lifestyle. It's a bit of a lonely activity, so I love activities such as this where I get to speak to people, even though you're not talking much. I do at least feel like I'm interacting with the outside world. What else? No, that's it for now. I think that's the most important part. So I'm very excited about the economy at the moment. It's a very strong, we might potentially be at the next golden era in terms of the stock market. We might be in line potentially for the next 7 to 15 years to be an incredibly strong bull market. At the very least, I expect the next few years to be very nice and bullish, but we will have our pullbacks as we go. So on the agenda, we need to cover how to analyze candlesticks to find support and resistance levels. These are very key. I'll explain why in a moment. We're also going to talk about how to correctly draw trend lines and interpret the findings for more accurate results. I think that's really important. How we use tools as technical traders is very important. Now, let's just say that you are a fundamental trader. You might have a different approach. It might be very difficult for fundamental analysts to buy into the whole technical analysis thing. And that's usually because they don't really understand it. It's really just that. The two can work together. They are different. There are benefits to technical analysis. I'll demonstrate those as we go. Then we're going to cover some interim price targets should the S&P 500 break out and make a run towards 5,000. We also want to cover some risk management strategies to minimize the drawdowns during those unexpected market moves. So the first thing that I would like to do, please, is to cover just want to clarify what is that difference between trading and investing. So I want to talk about the difference between trading versus investing, because there are two different activities, and I feel like that isn't covered enough. It's not, it should be, it isn't. It's very important to understand the difference between the two. So this is what I'm going to do is, let's imagine that I'm going to create a chart quickly. I'm just going to draw one. Let's imagine that we're looking at a daily chart for the S&P 500 or the SPY. Daily chart, we see it go up, creates a high, goes into a downtrend, then goes into an uptrend, comes back down into a downtrend, then sort of goes back up into an uptrend, and then sort of continues up. All right, so that's the chart we're looking at. Let's talk now. I'm going to change the colors, and let's talk a little bit about what an investor would do. Because these are two different activities, they occur in the same environment, in the same way that soccer or football and rugby occur in a similar looking environment. You've got a stadium with a green field, you've got similar looking goalposts on either side, you've got a similar number of players, but then as you look a little bit more closely, they're not the same. And you can't use rugby rules when you're playing football, and you can't play football when you're on a rugby field playing against a rugby team. You can't do that. They don't work. They're two different activities. It's like, different rules, different outcomes. So if we're talking about investing here, then let's start off with investing is when an individual, this is a generalization, but think of it as a dictionary definition or a layman's definition, is when an individual has spare cash and they're looking to get a greater return from putting that cash into some form of investment vehicle than they would get if they just left it in a bank with a high interest savings account. So looking to get a better return from that. Historically, the S&P can get anywhere from 7 to 15% and usually averages around 11 to 13% per annum. That's a relatively decent return, whereas you might only get 3 or 4% from the bank. Okay, so it's kind of, that's a better option. Historically, it's been a relatively safe way to actually generate wealth, real wealth, if you use, for example, an index fund. So the first part is that the investor usually it's a very passive activity. It is money they don't need right now. It's savings, some kind of a windfall. They want to be able to put it away. And often that means that the logic is they go, okay, it could be 500, 5,000, 50,000, 500,000 bucks, for example. And they just, usually what happens is they go, look, the sooner I put this into the markets, because historically that has been by putting it into stocks or putting it into property. Historically, those are the two most popular, generally wealth creating asset classes that have been chosen. So they usually go, okay, the sooner I put this into the market, the sooner it can start to work for me. So they're not really concerned about the entry price. Usually they'll go, you know what, I'm going to put it into the SPY. I'm going to throw it in. I don't really care what the price is. I'll just put it in now so that the sooner it's in, it can start to work for me. So then what happens is it has to go up with the good times, down with the bad times, up with the good times, down with the bad times, up with the good times, down with the bad times. But the idea is that on a long enough timeline, it should go up in value. That's the idea. So it needs time to bake, all right? It's time-based, time in the market. And that's investing. So let's just recap on that. It's usually money we don't need right now. The entry price is not often that important to us because the logic is that the sooner we put it in, the sooner it can start to grow for us. And then very interesting, often we don't really have an exit plan for it. As long as we don't need it and as long as it's growing, our logic is I'm just going to leave it there. It's like a piggy bank, except it's just earning more money every day, potentially dividends and so on. And so usually there isn't really an exit plan created for it. So very passive activity doesn't require us to make decisions about it more than twice. Put it in and take it out. And very simple. And it's spare cash we don't need right now. All right, entry isn't that important, needs a lot of time, doesn't really have a fixed exit point. That's really important because how we choose what to put our money in, because it has to grow over time and we just want to leave it, limits what we can pick. You wouldn't buy a car as an investment necessarily, maybe a vintage car, but you wouldn't just buy any car. So you'd be very specific on it. Bottle of wine, maybe valuable wine, maybe you'd put it into something. You wouldn't put it into currencies, for example. You wouldn't put it into euro yen necessarily because currencies aren't necessarily known that if you just leave them alone, they will increase in value over time. There's a very high probability that if you put your money into Microsoft or Apple or the SPY, there's a very high probability, as good as it could possibly be, that it is going to increase in value. So that's investing. Now let's talk about trading. So trading is when it's not a passive activity. This is when you need to earn a secondary or primary source of income from the markets. So this is when you need to be getting a monthly paycheck or extra cash from the markets, which means when you work backwards from that, it means that you have to have closed out your positions. You cannot withdraw money from your trading account to pay your bills if you haven't closed out your positions, which means that you have to be closing out positions every month in order to have profits to withdraw to pay your bills. So that means that if you're going to have positions that have to be closed out every month, partial or all of them, but it has to be enough and it's consistent. Every month there are going to be positions that close out. That means you're looking for opportunities that ideally you can get into and out of within that month. So in other words, positions that will last anywhere from a few hours to a few days, maximum a few weeks. So potentially now, if you're an investor, if you're more inclined to be an investor, you're starting to see the problem here because you're going to want to leave your money in, but that's not the same. You're an investor then. If you're a trader, you're going, look, I need to get a paycheck every month, so I don't care if I close all my positions. Can you be both? Yes, you can, but they are two different activities, two different strategies, different timelines, different ways of thinking, different criteria for entry and exit, different selection criteria, and different mindsets. If you're an investor and you think you can do trading without changing your mindset, you're going to become a cropper. You're going to make very bad selection criteria, very bad entry, poor entry decisions. You're not going to want to exit your trades. You're going to do everything wrong. So then just stick to investing. All right, it's exactly the same in that respect as soccer or football versus rugby. You cannot play soccer or football in a rugby game. You can't play rugby in a soccer or football game. You can't do it. It won't work. You'll lose. So if you're a trader, you're looking for much more shorter term single moves that the market has to do. That's really important that you understand this. You're looking for a singular move that meets your objective, and then you close it out and you look for another opportunity. It's almost as though if you were a property investor, you'd buy a property so that you can either live in it and pay it off over time or rent it out to earn rental income, but you're going to keep that property. Versus if your goal is to just find a property, fix it up and sell it. Buy a property, fix it up and sell it. They're different activities. They're different strategies, different mindsets. You're looking for different things. So if you're a trader, you're looking for high probability setups. You look at the daily trend, it's going up, price is pulling back. You see a nice little bullish candle here, nice little candle there with a wick underneath. You make the decision to get in 1 point above the high, stop loss 1 point below the low, and you target 3 to 1. So it's a trend-based strategy, looking for a pullback, looking for a bullish signal. This is your strategy, and you're looking for a 3 to 1, 3R strategy. That is the general, most sort of accessible strategy that most traders work, that gives very good returns. You do that, you should be exceeding the 12% or 13% per annum if you just left your money in. You should be hitting 15, 25, 30, maybe even 60% a year. All right, very important. Now you see the trend has changed. So now you're looking for a sell opportunity. So now you see a bearish candle, entry 1 pip below the low, stop loss 1 pip above the high. You're targeting 3 to 1. Okay, here you get another little setup there. You get a bearish candle. You go, that looks pretty good. Entry above the high, stop loss below the low. You're targeting 3 to 1. Price doesn't go to your 3 to 1, comes back. You get out of break even. Okay, it changes trend again. So it's much more granular. You're in the trenches. You're much more in flow with what the market is doing. Now, a couple more essential differences. When you're an investor, to a large degree, you do want to make sure that wherever you put your money in, that the conditions for it, in other words, the fundamentals for it, are as favorable as possible for as long as possible. And that's why, companies such as Amazon or Microsoft or Coca-Cola, they're not really going anywhere. So their profitability should continue into the future. Excuse me. Should continue into the future. But as a trader, you're really not concerned about what the market is going to do a year from now, 6 months from now. That won't impact what you do for the next few hours or the next few days. It won't. It has no relevancy. If gold is tanking a year from now, then I'll be selling it. If it's skyrocketing, I'll be buying it. So what it's going to be doing in the future is not relevant to me now. What is relevant is, what do the current conditions look like? What does it look like it's most likely to do in the immediate future? So let me give you another example of that. So first of all, before I do that, I'm just setting it up so I don't forget. So let's wrap this up. So investing, very passive, spare cash you don't need right now. You just want to get in the market as soon as possible. You're not really too worried about your entry price, and as long as you don't need it, you can just leave it there. You don't really have an exit plan, but you do need it to go up in value. So it's got one direction it can go. Trading is very different. You need to earn an income every single month, which means you need to have those positions close out on a regular basis. So each trade has an exit and a finite duration or a finite distance, but it's a finite lifespan, fixed. There's no way around that. If you're finding that bugs you, then you probably want to be an investor. If you're happy and you know the difference between the two, you can do both. If the market's going up, you're buying. If the market's going down, you're selling, which means that you can look at different asset classes. So now you can look at currencies. You can look at maybe commodities that are seasonal. Okay. You have a very precise entry to a pip or point and a very precise stop loss and a very precise target or exit plan, whether it's a trailing stop combined with taking partial profits, but it is rule-based and it is non-negotiable. And again, if you'll find that that bugs you, that it's non-negotiable, then investing is most likely for you and not trading. So I said to you that trading is about looking for that immediate next opportunity. This is a bit of a wax on, wax off activity. All the things I'm doing now will come together when we move to the real charts, because when I explain why we would do something, you'll actually know why it'll make sense within the context of either investing or trading. So let's just say the price is broken up through a level of support, tested it, level of resistance, broken up, tested it for support, looks really nice and bullish. The trend is beautiful, it's just trending higher, looks really, really nice. There's a next major level of support or resistance up here. Price is trending beautifully, it's pulled back, maybe it's come back to little just to test a recent high, maybe it's testing a Fibonacci level, maybe the moving averages are just traveling, excuse me, along here. So it's reached a whole lot of little conflicting, sort of not conflicting, confluence, sort of converging points. You get a beautiful bullish candle here. If you put your entry there and your stop loss there, the probabilities, like which way does it look like it's going? Well, it looks like it's going in this direction. It's behaving very nice and calmly. There's a potential here for a 3R type of trade setup from there to there. 1R, that'll be 2, 3R. Trend looks really good. It's a very nice, got lots of reasons to take it. Nice little uptrend, bullish candle, testing support resistance, Fibonacci level, moving averages. MACD looks nice and bullish. A whole lot of things and saying, look, if we take this, the chances of this continuing up here are as good as possible. So you take a setup like that 100 times, 80 times out of 100, it's going to continue on and hit target, no problem. Maybe 20 times it'll either break even or go the other way, fail and go down or come down. Maybe it'll come down here a bit and then go back and then go up there. You can have that kind of thing happen. And then you have to take another trade over here or another trade over here to get the same 3-to-1 setup. So that's trading. It's looking for a very high probability setup with the immediate impulse. The next move of what the market is going to do is pretty clear, and that's all you're looking to do. It's almost as though you're playing catch with someone, and you're throwing the ball back and forth, and you see them lean back, and their arm is in motion towards you, and you've been doing it all afternoon. There's no reason to suspect that they're not just going to let the ball's going to fly, and you just got to make sure you catch it. So that's all the conditions are there to tell you what is most likely going to happen next, and you're going to take advantage of that. And you'll be right more often than not. That's really what trading is. I am thirsty. I'm going to ask my significant other for a juice. Sorry. And then I'll just give her a smiley face because I feel a bit embarrassed. Almost there. Okay. Now my dog wants to come in. She wants to keep me company. Okay, so that's really important. All right, so that being said, let's go. And the only other thing I want to add to this is that I want you to understand we've got this technical move. You know, there's a push and a pull, push and a pull, extension, retracement, extension, retracement, on the way up, extension, retracement, extension, retracement, push, pull, pull. And when we look to join a trend, so when a trend looks really nice and good, there's only two ways we generally as retail traders will get in on that. Either on the pullback, the retracement in an uptrend. So we're going up and we're either looking for a pullback. So anywhere here starts to look really, really good. So when it turns around, anywhere in this area looks really good if we can get in on that pullback. And the last place we will consider getting in is just above as we break to a new high. So that becomes a breakout. So that means that anywhere in this area is the optimal place for us to get in on a trend. Okay, there's a pullback, we get a nice little retracement. The last place we can get in is on a breakout. So every entry into a trend is through a pullback or breakout. And that leaves anywhere in this area. Anywhere outside of that is the worst time to get in. So what happens is most people are very nervous. They like a stock, they see the stock coming down, they panic, they think it's not going anywhere. Then they see it turning around, but they're not sure if it's going to go anywhere. They see it break to a new high. They hear the media go, oh, it's all-time highs. They see it going up. They're still not sure. Then they decide now they're going to get in. So they get in now. The market goes up a little bit, and then it starts coming down again. And so now they panic. Maybe they even, oh no, it's coming down to these highs. Oh no, they get out, it turns around and it starts going up again, and then the whole cycle repeats itself. So what happens is they're getting in here, continually getting in at these points all the time when they should be getting in outside of those. So they're out of sync with the market cycles. And that takes training and practice and education. All of that being said, let's go and have a look at the charts, because all of that is going to be relevant to what we kind of talk about now. So we're going to talk about candlesticks, support and resistance levels. We're going to talk about how to correctly draw trend lines and interpret those, interim price targets, and those types of, and risk management strategies as well. So we'll come back to this at the end. I really like the colors. They're very cool. And let's go and have a look at the, not that platform. Let's go and have a look here. So first of all, what I want to do is just give you a broad overview of the charts. And when we have a look at it, we're now looking at the SPY on a monthly time frame. Looks beautiful. You can see we can go all the way back here to 1995. You can even see over here the last kind of, there was a bit of a bear market there, and you can even see here is the global financial crisis. So this is 2007 to 2009. That is that bear market on a monthly time frame. So when you get a really strong downtrend on a monthly time frame, that is almost always a bear market. So we had this really strong bear market here, then we had a pullback over here, we had a bear market over there, and these are very strong ones. These are not just pullbacks. So there's a difference. That's a move and a pullback and a move and a pullback. But when you get something like this, when it's actually a trend, that's usually a bear market, and then it goes back into a move and a pullback. Okay, so here you can see move, pullback, move, pullback, move, pullback, so on. And then here you actually go sideways. This is really interesting. So this period here is kind of roughly when Obama came in and Biden, and actually they oversaw recovering America. So this is what I find so amazing, is they happened to, the last global financial crisis we had, which was the GFC, they managed to recover it. They got all the way through to about here. So this whole period over there is Obama and Biden. So Biden, people forget this. The media is so weird. He has done this before. He has done this before. He's very familiar with this. Don't worry about that. I was trying to enlarge this full screen because there's usually a way in which I could do that. So he's done this before. Anyway, so then you have what's known as a presidential year, which is interesting because we're in a presidential election year now. So actually he did 8 years, and this was his 8th year. So this period here, where you go from approximately here until approximately here, was 2015 to 2016. Okay, so this was, sorry, I beg your pardon, was 2016. And it's at this point where Trump becomes president in the US. And the market proceeds to head up a little bit. And this is essentially Trump's presidency, this period over here. So what's interesting about it is that, to me, this is really just a continuation of this behavior. You can see how nice and calm it is. And then it becomes pure chaos. Just pure chaos over here. The market's going largely sideways. It's whipsawing a bit. This is COVID at the end. Pure chaos. Then Biden comes in. The market recovers. Starts going up again, actually quite aggressively. Then we have a correction. So this is where it gets really interesting. I say this because this was the global financial crisis. This was COVID. And that was it. COVID was actually the biggest bear market or correction that we had since 2007, 2009. We had it. The market then continued up, and now we had, and the thing was that COVID was not related to the markets, whereas the GFC was market related. So that's a proper bear market. This is almost just like a worldwide shock to the system. This was this is really our first market related. It's inflation, bit of fear and panic, war breaking out, this to me would really have been our most recent bear market, excluding COVID, from 2007 2009. Why is that a good thing? It means that we've got a long run before we should hit our next bear market. And the correction, the length of this correction and the length of this correction is roughly the same. Okay, and also in relation to the move here and the pullback, it's a very nice fib retracement. So what am I trying to tell you? I'm trying to tell you that the 22-23 market correction we had is the biggest bear market correction we've had in the last few years. And even if you want to include COVID in that, it really does mean, thank you, it really does mean that we've had our bear markets. We've had them. We're now due for a bull market. We're due for a really nice bull market run. And this bull market run that we are currently in is the part of that. My dog, give me a second here. Take your thing and go. And this, what about this? So we really are in it. And it's very hard to see it. When you ask people, why didn't they buy at the bottom? When you ask them why they didn't do that, it's because when you're really at the bottom of that, it's doom and gloom. When you're at the bottom of COVID, nobody could understand how the markets could recover, and they did. And when you're at the bottom of this last year, the media was just terrible. In fact, it's only been, I kid you not, in the last month where the media started to accept that actually life isn't so bad right now. So that's where we had to get to, and it's been going on for a long time. And this is how it is. When life is here at the top or in these areas over here, nobody can ever imagine that it's going to end, and then it does. And at the bottom, nobody ever thinks it's going to get better again, and it does. So I want to show you, I want to give you some perspective that right now we are in the relatively early stages of the new bull market. And in fact, actually, we've already missed some of it, meaning we've just had our very first retracement. So this is an uptrend, then it goes into a downtrend, and then it goes into an uptrend. We've just hit this kind of way over here. So if you kind of look at it, there's our low to our high, high low, and high high. We've just sort of broken above that. We're in the early stages of our very first, we've already had our first retracement and our confirmation of an uptrend. So I would say that we've potentially gone through a third or a quarter or a fifth of our next bull market. Okay, but we're still in the early stages of it. It looks fantastic. This is very important. Okay, because a lot of people are not appreciating how good things are. And I wanted you to see with your own eyes. Obama and Biden, this part is Trump, and this part is Biden. It's very crystal. You can see it's like a heart rate. Now, I also want to add this. The earnings of companies, like the trillions that they make now, Microsoft and Amazon and Meta. Oh, that's very strong. Is companies make much more. There's way more people on the planet. There were probably 6 billion people on the planet there. Now there's 8 billion people on the planet. More people working, more people entering the workforce, more jobs, more businesses, more money in the market, more people trading. So if you're wondering why the size of the candles have gone from this size to this size, is because the retail market, which is us, has gone from just 5%. We used to make up 5% of the market. We now make up 25% of the market now. We just make up some more, and there's algos trading as well. There's more activity in the markets. The candles are bigger because the moves are bigger. It's a bigger market. It's becoming bigger and more voluminous. And so looks relatively bullish. And it looks really nice and healthy. What else have I got on the charts? I've got a 50 moving average, a 20 moving average, and a 10 moving average. The moving averages here are just it's just a fantastic technique to frame price action. When the trend is strong, the 10 and the 20 and the 50 are fanning out, and price is trending on top of it. That's beautiful. All of those conditions, that's what a great heartbeat of a stock or a company looks like. So let's have a quick look. Let's deviate so I can show you something else. Let's look at something else. So look at Microsoft. Look at Microsoft's heartbeat. Beautiful, beautiful. Let's look at Berkshire's. So if you show me that I can, if you show me the heartbeat, I will tell you if it's a good company or not. How's Tesla doing? Tesla's not doing well. If you compare the heartbeat, Tesla is not in great shape. You can see it for yourself. But I was going to say it's a relatively new company, but it's not. It's got some history behind it. What else though? Let's look at Disney. Disney is also struggling a bit. The heartbeat's also not looking very good. Starting to recover, starting to turn around though. And it used to look great. Used to kind of generally trend up. Not looking so good now. Let's have a look at Netflix. Okay, Netflix looked great up to there. Then it had a correction, and now it's looking good again. So Netflix looking great. Amazon looked amazing up to there. Now this is also a really good time to show you what parabolic means. So when you hear people talk about a stock going parabolic, what they mean is that there's if a stock is just going sideways and the angle is just flat, it's in a coma. It's not really doing anything. And as it starts to gain momentum, the angle of momentum starts to change. That's really nice and sustainable. Then it can go a little bit further. It looks a little bit sustainable, but then it might get to a point where it starts sort of going straight up like this. And so that momentum, the frenzy around buying that stock has gone from very sort of docile, not really happening, to taking off. And you can see it here, and then it just goes like this. So here you can see it going parabolic. Cryptos did that as well. So Bitcoin also went parabolic when it did that. There's been a few that have had that. Tesla actually had that in the beginning. Tesla went parabolic. Okay, sort of just straight up like that, from going pretty flat. So it does kind of happen. Amazon had it. Apple's had its moments. Okay, look at the history of Apple as well. And yes, there's a bit of a growth. Now, the reason I want to bring that up is that when we have a correction, it's likely to bring us back to the 50-period moving average. So when you have a really big correction, price goes up here, then there's a big correction to the 50-period moving average, to the 50-period, to the 50-period. A lot of COVID came back almost close to 50-period. And so that 50-period is a really good indication of when you have a big correction where that market will come back to. So we're going to have a look at the SPY. So why is the S&P such a great chart to look at? There we go. I knew I could make it full screen. I knew I could do that. That's what I was trying to do earlier. Why is this such a great thing? Well, first of all, the US economy is the largest economy in the world by a long way. At the end of World War II, 1945, the US possessed 95% of the world's wealth, right? 90% of the world's transactions are done in a US dollar. Once you start not looking at currencies, looking at commodities, crude oil, gold, so on. They are the world's reserve currency because they've been doing it for a while. The economy is bigger than the next 8 countries combined. Take China out, the US economy is bigger than the next 8 countries combined, the GDP. Now, China's economy has shrunk to 60% of that of the US's. The US is behemoth. It is titanic. It is absolutely massive. And it is the world's reserve currency as well. And it's going to be that way for a while. It's also the largest military in the world. The only other country that has more nukes than that is Russia. But the military isn't anywhere in comparison. I think you could throw Russia and China, excluding nukes, Russia and China's military together, and the US is still dwarf them. The point here is that the S&P 500 as well is made up of 500 large cap companies and medium cap companies that are all around the world. They're global. So you've got your McDonald's, you've got your Starbucks, you've got all these different Nike, Microsoft, all these different companies that are global. And so when you look at the performance here, you're looking almost if all the world's biggest companies that are all around the world were then put into one sort of index, that was give you a great idea of what the global economy, how it's doing. So if the S&P 500 is doing very well, it's a really good indication, at least, of the global economy. It's beautiful. So the S&P is really the most reliable of the bunch. The Dow was the very first one. So the Dow Industrial Average was created in 1896 by Charles Dow, made up of the 30 biggest sort of companies. Back then, we were in the industrial era, so we had shipping and rail and transport and mining And it's the beard. I realized that the beard I'm growing now is just making my face itch. And so that was a great representative of civilization back then. But today we're not just, we're other things. We're technology and all kinds of other things as well. So the S&P is a better cross sample of that. And then the NASDAQ would be, out of those two previous ones, the NASDAQ would then be the biggest 100 tech companies out there. Okay. And so, people don't appreciate outside the US how the US is the biggest cog in the system. It's like a miniature horse and a cart horse. They're just completely different. Okay, so we need to just understand, and the economy is doing really well. It's very stable. As long as you've got a strong middle class, you are relatively stable economically wise. Okay, and so here we go. I wanted to just show you how nice and strong this is doing at the moment. So this is the SPY. It looks fantastic. So it's in an uptrend. And the only thing I want you to be aware of here is the distance that price is away from the moving averages. So every now and again, price has to come back to the moving average. You have to get that retracement. It's breathing in, it's got to breathe out. Or the other way around, we want to say it breathes out, and then it's got to breathe in, so it could do the next breathing out part. And it's had a really nice breathe in, and it's heading up now. But there's a bit of a distance between these, and we've just passed these new highs here. So what does it mean? It means that at some point in the future here, at some point in this future here, we have to expect, just going to be like that, aren't you? We have to expect this, that it's going to do a pullback to that. Maybe not like this. It might be a smaller one. It might be a much smaller one like that. But we have to expect that as part of its behavior. It's normal. We need to expect it. So let's go now and have a look at the weekly. So as an investor, which is a much more slower moving thing, the weekly becomes one of the most important charts to pay attention to. Funny enough, most investors look at the daily, but the weekly is really where the magic is. When you look at the weekly, one of the things you want to do, so I'm going to talk a little bit about risk management and buying. So remember that when you are trading, you want a stop loss, because ideally you're looking for 3 to 1. If it doesn't go your way, you want to get out, and then you want to wait till it does go your way. So that's your goals. Get in and out. Yes, it hurts. You take the loss when it goes against you, but it only goes against you a small portion of the time. When it goes in your favor, you want to get 3 to 1, so it makes up for the losses. As an investor, you're ideally looking to get in and hold, for a period. And the weekly is just one of the most incredible time frames to do that. If you look at the 10 and 20 here, these two moving averages here, and you think of that as a train station on the weekly time frame. So we're focusing on the weekly time frame. You'll notice that often when the train leaves the station, it comes back to the station, leaves the station, comes back to the station. So collectively, you look at the 10 and the 20 here as a train station, it points to a fantastic location where if you were looking to add to your position or get in on the move, the 10 and 20 moving averages, especially when the 50, 20, and 10 are all in the correct order, the 10 and 20 becomes a great location to look for a buy opportunity, to join the trend. Because remember, we want to get in on a pullback or breakout, pullback, breakouts. And these pullbacks happen in the train station. They'll come back to that. Okay, and every now and again you get your bigger correction. So on your monthly time frame, you're getting your monthly pullback. Okay, that's your monthly pullback there. But your weekly is all occurring. So it's fractals within fractals. And these areas represent really good times to join in or get in on the move. For investors, yes, traders could do it as well if they were looking to hold a position for several months. But I think for the purposes of just simplification, keep investors here or getting in on the weekly, and look at traders getting in on every other, like on timeframes on up until the daily and no later than that. Traders can use this as a clue. Go, okay, well, if price breaks above that high, I'll get in on the daily on a lower time frame, on the 4 hour, on the 1 hour, but I'll use the analysis here to guide me. The next thing I'm going to tell you here, and it's somewhat proprietary, is that very simply put, how to know if we're in a bull market. I've got about 8 criteria, which are bulletproof, but very simply put, generally speaking, if price is above the 50-period moving average, if it's above the red 50-period moving average on the weekly time frame, we're in a bull market. That's at least one criteria. If we have an uptrend, high lows, higher highs on the weekly, we're in an uptrend. So if you combine the price action and the 50-period moving average, if that's producing high lows, highs, and it's above the 50, you're in a bull market. Whether the media says it or not doesn't matter, but you are in a bull market. So you can see when we had COVID, you can see when price dropped here and got back up above the 50. That was really you could argue back then you were going back into a bull market. But even if you didn't believe it, you had a pullback here and you broke the high, which means at this point you would also have been above the 50 and had a lower high, low, high, high. You'd be in a bull market. And even if you didn't believe that, you could have produced this pullback and this break, and over here you'd be in a bull market. But there were tons of signs that you're in a bull market at that point. So here we go into this break, and this is Russia invading Ukraine. This is high inflation, global inflation, and all kinds of problems. The market goes into a bear market. Here you can see price starts to recover. Or is this COVID? Hold on, is this COVID? I beg your pardon, ladies and gentlemen, this is COVID. Big panic. I thought that was a very sharp drop. Here, when do we get above that 50 period? So here we're back above the 50 period moving average. Arguably, we've produced a slightly high low with that red candle. So stretching it a little bit in terms of the definition. So we've gone like this, produced this pullback, and we've gone up, we've above the 50 period. So this would be technically very fresh, but that's where you could argue you've entered the bull market, you've recovered, which is, there we go, and around about May 2020. But if you didn't, if you're too nervous to declare it, then you would wait for the next pullback and the next high low. So here you get a pullback, there's your pullback, and next time we break above this high, we should be in the market. So wait for it, wait for it, wait for it, wait for it, boom. If we've broken it there or the next one, which we will, there we go. We're now in a bull market for sure. We've broken above the 50 period moving average, we've come back, we've bounced on it, and we've gone. Remember how we come back and bounce on it, bounce on it, bounce on it? We've come back and bounced on it. We are 100% in a bull market there. So price goes up. We're waiting for Russia to invade Ukraine and all that crazy stuff to kick off. So that's COVID. We managed to recover from COVID. Price is going on. It's doing its thing, doing its thing, doing its thing, doing its thing, doing its thing. Beautiful. Look at this beautiful bull trend. Look how many opportunities people to get back in. If you didn't get in on that one, that's a no-brainer. This is also another opportunity. And then you get all these other little ones that are very, very tricky because they're small touches. But there's another pullback. There's actually a breakout. Boom. So much going on. Lots of entries in weekly when it's smooth. It's great. Another little bit of proprietary knowledge. I mean, the candles are very big here. So look how small they are. Then there's panic and fear. They're big, big, big. But then they get smaller. So here they go back to their size. That tells you the market has calmed down. They're a little bit bigger now, but that's because overall the market's got bigger. But they've definitely shrunk from this, which tells you the market has calmed down. And I know this from experience now because I've done all this. But when that happens, the media is still, oh, panic, panic, panic. But actually the market is now functioning normally. So that means that certainly, I mean, if you weren't sure about it by this time, by the time this pullback happened, boom, that's to me, with experience, obviously, that is like no-brainer. Bull market, looking good, very nice pullback. All right, market goes and looks good. We had a nice pullback. So go, 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 go. And waiting. 21, we're in 2021. That looks good. Everything looks good there. All looks good there so far. Looks good. Remember when you start to get bigger candles. Okay, so now we've come back to the 50. So and the candles are bigger. So the market's not as bullish now as it was here. Okay. If it breaks below this low, so in other words, now you're back below that 50, then we're back into a bear market, guys. Then we're under the 50 period moving average. So broken below that. So it's looking like we're in a bear market. Looking like it. Yeah, we're definitely struggling a bit here. Goes back up above it. Now it goes back below it. Breaks below that. Boom. Okay. We like a lot of a wobble here. In other words, it's like it's drowning. Here it's got its head above the water. Oh, chokes. Now it's dropped under the surface. Bear market. Market goes down, stays below that. Now we're under that 50 period moving average. We're under that, battling. Now we're watching to see if we can get above that 50 period moving. Boom. Now we've kind of closed above it. But if we break above this high, we've gone from lower highs to higher low. So there's your low, there's your high, higher low, waiting to break that, and we'll be above the 50 period moving average. And you know what's going to happen next? It's going to come up and come down and bounce on top of the 50 period moving average and take off. because that's what it does. Okay, so it's come up and come down. Let's see what happens. Let's see what happens. Boom. There's your bullish candle on the 50-period moving average. We broke that high, so we've got high lows, high highs. We're above the 50-period moving average. We should technically be in a bull market. Let's see what happens. Boom. Then it goes up, carries on. Okay, so we're definitely there. So let's have a look. Let's come back to where we are today. There we are. We came down, bounced on the 50-period moving average. We're definitely due at some point in the next 6 months to have a bit of a correction to the 50-period moving average. We're a little bit high on the monthly. We're a little bit away from the moving averages on the weekly, but not ridiculous. The question really is, the question this whole webinar has been about is, will we encounter one of these or one of these patches in the next 30 days? So let's go and have a look. So far it looks good. There's a very good chance we won't. We should still be able to continue up. I don't think we've run out of, I don't think that extension phase has really pushed its limits. I don't think we're there yet, but we can look at the daily. So this is where we can usually find clears. So what's beautiful about this is that we've already had a beautiful pullback and a bullish candle. So as we're setting up here, this looks good. That looks really nice and bullish. But this is where it gets interesting. So imagine that bigger move. There's the weekly going there and pulling back, or even the monthly, which is from there to there and going up. The daily, meanwhile, is move up, move down. So you've got smaller moves within the bigger thing. One of the things that happens when the market is creating these new highs, but is eventually getting tired and is going to do a bigger move down, the MACD changes. So here you get a high that matches that high. Then you go up to the next high, you get a higher high there. But this time you go up to this higher high, it's lower. So all you know is that at this point, the market is becoming tired. Why does it say that? It's saying, well, the speed at which you went from there to there, it took you much longer to go from there to there, or you didn't go as far in the same amount of time, same thing. So it started to fall. And then what happens is you come down, you start to break the lows, come down to these lows. And then it went to a lower high, and a lower high, and then it broke that low. So that's actually how it started, but the clue was here. So we call this divergence. The momentum starts to fade. This is incredibly reliable, accurate, powerful. It's amazing. So what we want to do is see if we're seeing that now. So if we're seeing it now, that would tell us if the daily, in other words, because we've got 3 weeks in February, it's a very short month. So that's actually about 15 days, 15 candles, maybe 20 candles. Like, I feel like I'm being generous here. It's 15 candles. Okay, maybe 18 candles. So if in the next 15, 18 candles, we're going to run out of steam, we should see a bit of divergence. What should happen is we should be seeing a little bit of this potential. So maybe if we're here now, we've got the potential to go up here, but maybe we're already seeing a bit of divergence. Maybe we're already seeing that. So let's have a look and see. So we just go forward to where we are now. So when you look at this, let's go and look through those highs. And I'm not worried about anything to the left. Don't worry about that, because here you've got your lower highs. So there you've got your lower highs coming down. All right, price breaks through there, price breaks through there. We're now on a new trend. So in other words, I'm only worried about what's happening now. That's all matched up. All of that has been matched up. Now we just need to worry about this. So we've got highs as we go. Look, there is one here and there's one here. And yes, technically we've got one here and we're sitting over here. So it is a little bit tight. We've had this was a very big move. We've had a bit of a consolidation here. So let me remove this. This is a bit of a consolidation over there. And we broke out. We've pulled back a bit, produced a bit of a bullish candle. And on the whole, you can see a high here and a high high. So if you include this and this, it's bullish. It's looking pretty good. And again, I don't think we've reached our limit just yet. I don't think that the monthly is that overextended. I don't think the weekly is that overextended, and the daily is not overextended at all. It looks beautiful. It actually here is a bullish signal. So where it gets interesting to me is if we fail, it is going to try and go up from here. It is. If we fail and go down, then that will just be our correction. We're still in a bull market, ladies and gentlemen. This is the most important thing I want you to remember from this. we are still in a bull market, which means that we will have weekly corrections. And during the weekly correction, the daily will go from an uptrend to a downtrend, but then back into an uptrend. So even if we have a correction now in February, it's only a weekly retracement. The question really tonight in the webinar is, are we going to have that weekly retracement, or is the daily going to continue up as we go? And I'm saying right now it's actually 50-50. I'm saying the daily here is signaling it wants to keep going. I'm saying the monthly and the weekly do not look overextended, so the odds should be in our favor. If the market is bullish, we should be able to go. The only reason I wouldn't go and say with a 90% certainty isn't even really this. It's just that historically, September's and February's can be funny. They can be. And that's the only reason why. And we had all of our terrible period here. This was all September. Well, September was the worst month where everyone panicked. And actually, the funniest thing is that nobody even thought we were in a bull market all the way until like here now. That's how bad most people are, the public and the media. Sorry, not you, just the media, at recognizing it. The media prefers to give you fearful news because they've worked out that it gets more clicks. But it doesn't help people. So when you hear about people who struggle with their investing and trading, it's because they're getting they're being driven by all that stuff, and that stuff isn't helpful. When you get trained, this is how you do it. So this looks pretty good, and I'm also relatively optimistic with how this is looking, and that I think we've got a really good chance. So it's pulled back. You get these nice pullbacks, bullish candle, it goes, pullback, bullish candle, it goes. We've got a beautiful pullback here and a bullish candle, so it is looking good. What is its potential? Well, the smartest thing says we've got 500,000 right here. 500,000, nice round number, makes very much sense that it's going to head up towards that. At least to 500. I beg your pardon, not 500,000, but 500. It's going to head up towards that. That makes the most sense. That's what I'm looking forward to. Tomorrow's Friday. We'll have to see how it goes. Tomorrow's non-farm payroll. So we might have a little bit of a correction, but I am expecting by February that we will get up to. Once we get up to that number, then we're going to have to see how it goes. We might even get very lucky. It breaks through that, comes back, retests it, and then we get one last push, and then we get a bit of a correction in March. We'll see how that goes. But for the most part, looking very good. So this was to talk a little bit about support and resistance. Support and resistance, really, if you take everything else off the charts, the most important stuff you get are horizontal price levels and price. Why? Well, both fundamental and technical analysts are all about price. 500 is a psychological price. It's a crowd behavior price. It's a value price. So 400 as well. So those round numbers tend to have significant impact on the markets. People who don't even look at charts will make decisions based on numbers. And so that reveals itself when we look at the chart, it starts to show itself. Okay, so if we go through and then draw a number off that, so we go here, we look at 400, let's just go, we draw something there, we tend to get a bit of a response. We go up here, we might get something at 450, so that's 450, that shows that it's resistance and so on. A bit of a level here at 410. And so we often find these numbers tend to show up and they provide us as a reference, and price tends to go from one price to another. So if it breaks through 450, it'll go down to 420. That's how it tends to behave. It's a bit self-reinforcing, but that is also what fundamental traders and investors are doing. They look at the numbers and they're going, okay, well, if Tesla breaks, or I think it's undervalued at $100, but if it breaks $100, then I think it's going to go down to $60. And so those things start to form themselves in the actual charts, and technical traders identify those levels as well. And so it becomes two sides of the same coin. The market tends to behave. But one of the beauties of what price does is price is very much, we can then see how the market is reacting when it gets to a particular price. So for example, over here, when price hit this level, there was a bit of a reaction against it. When it did it again, it got a second reaction, which was much heavier, and then it did a bigger move. And we could see just from the second candle and from that behavior, what happens. So when you get a very bearish red candle, and you got lower highs and lower lows, you're getting that confirmation. And that's the beauty of technical analysis that way. So support and resistance becomes very important for us as traders. So for example, here, I can also see that if I look at this level, there's a nice level of support there. It's got multiple touches on it, a little bit of a level of resistance over there. If price breaks this level, price happens to do this, come down, produce a lower high, come down, break that, I'm going to start to pay attention to it. I could be looking at a weekly retracement that's going to carry on, potentially. And if it breaks that, then I'm going to be looking for it to come back down to these levels. So those levels become a great way to guide us into identifying those potential opportunities. Now, trend lines. So this is really interesting. The technical sort of tradition of a trend line is that traders often noticed that there were behaviors that the market would respond to a trend line almost as though it was finding support on a trend line. However, I'm of a school that doesn't really use it that way. I find that trend lines do observe channels where price can operate within a channel. Because remember, I was talking to you about the angle of momentum. So when price is going sideways, it's not really going anywhere. As it becomes more and more bullish, the angle of it starts to go up. And then if it becomes parabolic, it's going almost straight up. And the same as if it starts to panic, it starts to drop and go down quite a bit, quite steep. So the angle of momentum is really one of the most powerful ways of using a trend line. So why do we say that? So again, let's go and get rid of this. And let's go look at this from a weekly perspective. How do we use trend lines to help us determine the bullishness or bearishness of the market? So remember how we said we had a bear market here. So again, if I just draw a trend line that generally goes in sort of parallel with price action now, it doesn't even have to be that accurate. I could just do that. But if generally price is above the 50-period moving average and it's above this trend line, it's bullish. Then we can see that point where it starts to fall through the trend line, starts to break through it and below the 50-period moving average. And so that line becomes a great compass line or line in the sand that if price is above it, it's bullish. If it's below it, it's bearish. And if it breaks above that, that actually tells you the angle of momentum is changing. And again, if you do it the other way, if you take price here, move it up to the top, if you were watching it from this perspective, if you were watching it here, you'd see that price is staying below that angle, that line. And eventually here it starts to breach it. It's just a little bit of breaching it. So even if you didn't quite buy it, you could adjust the line. But if it breaches it again, which it does here, now it's definitely breaching it. Plus you've got a high low, and there you've got a high, you've got a break of it. So all these things come together. You've got a high low, higher. Price action has gone into an uptrend. You're above the 50-period moving average, and you're above the trend line. And it is a remarkable, incredibly powerful way, a compass that tells you, okay, the angle of price is now starting to shift. It's breaking through that downward sloping trend line. It's now starting to look bullish. And so how do we do that now? Well, right now, the angle of price, trying to do this, get that over there, and bring it over here. If I want to keep an eye on the daily, go look at it from a daily perspective, and just make sure that I'm above this general sloping trend line. There. I do that because if I'm concerned, for example, that price is going to possibly, I just have to go back up to the weekly and do this, and then I'll wrap up. There we go. Go back to the daily. Okay, it's going to be like that. But generally speaking, if I want to stay above these trend lines, yes, I might then use this and say, okay, if you're above those, we're generally bullish, then it's just a daily retracement. But if we do start to breach that trend line, then I'm going to look at the weekly because we might be getting a bit of a weekly retracement and then use that as a frame of reference. So there we go, ladies and gents. I'm going to wrap this up. Let's go back over here. I want to say thank you very much for attending. I really hope I appreciate your time. I hope you appreciate what I've been covering here with you. Markets are looking absolutely fantastic at the moment. Generally speaking, we are in a bull market. And so it really becomes a question of where in those pullback extension cycles are we for the individuals? And the SPY is a great way to have a look at that. It looked right now, all signs point to it having a good February. But again, we've drawn those lines in the sand and the moving averages. We can get a sense of if those conditions are starting to change, but it does look good so far. So on that note, ladies and gentlemen, I was going to say to you, if you have a question to do with the platform or to do with your account, please don't hesitate to get in touch with the lovely folks. Here are the contact details available, whether you want to do it on social media or phone the numbers, or just email them. And that was it. I was going to say, on that note, I'm going to let you go. Thank you very much. I'm going to end the webinar, which is going to hoof us all out. And I want to wish you a wonderful evening and a fantastic weekend. So thank you very much.